Welcome back. You're watching Stock Watch with me, Zanatit Guma, and joining me to take your stock-related questions tonight are Pierre Verster from Protea Capital Management and Roy Mutooni from Sanlam Investments. We are pre-recording today's episode, but do continue to send through your questions on email at stockwatch@bdtv.co.za or via SMS to 41392 or on X using the hashtag StockWatch. Thank you so much for your time, gents. A theme that I've been seeing and hearing about and actually talking to a few people today is the two-pot system and really what we expect from that. I've had quite a lot of descriptions. So Kevin Links, the chief economist at Sanlam, said that that's going to be a sugar high. Wayne McCurry was basically talking about its impact on basically the boost in like the consumption exposed stocks on the JSE. JP, just starting off with you, is there a big expectation on the impact of that, particularly for JSE stocks? And maybe if there are certain sectors that you are really thinking that, yeah, this is going to provide some sort of sugar high?
Yeah, good evening to all the people watching. The viewers. Personally, I don't expect a huge impact because of the two-pot system. Yes, when it comes into effect, your accessible pot will be seeded by up to 30,000 Rand, which you can then withdraw before the end of February next year without too much hassle, although you'll be paying tax on that. So because you'll be paying tax on that, I really hope that not too many people will withdraw, because you are basically withdrawing your own money, and you'll get more money today, but it means you'll get less money when you retire one day.
Yeah.
So the only real reason why people should be withdrawing is if they have very expensive debt, and it would help them to pay off the debt. But if there are people who are going to withdraw and then spend, I think a company like Lewis would benefit from the furniture that they sell, and some of the other retailers like Shoprite might as well. But I'm really hoping it has very little impact, because I'm hoping not a lot of people withdraw, because it's actually not very good if we do see significant withdrawals because of this.
Yeah. I mean, Roy, could maybe the anticipation be a little bit overdone because of maybe what JP says, the fact that you have to pay, a lot of, tax on it, but also maybe a better option would be just to pay off your expensive debt?
Just remember that the whole point of this was that people felt maybe I've been retrenched and I have this pot out there that I didn't have access to, or I have an emergency, I have no cash savings, I have this pot that I'm going to cash in 30, 40 years, whatever the time. So I think that was the benevolence that maybe we need to recognize because of the hard economic times, we need to give people access. So the experience internationally has been mixed. I think there are two places, those Chile and I think Australia, that did it. What tends to happen is people rush in, do the withdrawal, and suddenly realize actually this wasn't the right thing. They'll spend and everything. So you have a big jump up front, and then over time it diminishes. Remember as well that this is not new, because up until now what people tended to do is resign from your job, or if you're retrenched, and then that money tended to be spent. And the track record of that money tended to be spent on paying down expensive debt and then on retail. So I think it's much of a muchness. There could be a little bit of a, the spending will come through, but I think over time, you'll see people getting to be a little bit more astute as to what exactly they do with it. But like JP says, nobody's giving you money. This is your money. The whole idea was that it's supposed to be for your retirement. The only thing you're being told now is if you have a real dire emergency, this is one aspect. This is one pot you can maybe stick your finger into.
Yeah. There's also another sector of the economy that I guess some people think that this money is going to flow into, and that is your home improvement, building materials sector, your Cashbuild, your Italtal. And what was quite interesting is that, you see the share movements of Cashbuild, and they've really been hammered. But today there's a little bit of some relief. JP, do you think that maybe we can expect some sort of significant flow in there, or maybe we're not there yet?
I think we'll see some flow. I wouldn't necessarily think it would be significant flow. But again, we're talking about human nature here. It is
Yeah.
by definition very difficult to forecast human nature. We also saw yesterday a trading update from Italtal, which was
Yes.
quite negative. I mean, the revenue growth is indicated to be lower than the previous period. So it shows that things are still tough in the home improvement market, both for your finishes like tiles and sanitary ware, where Italtal is more exposed, and then your more basic building materials like a Cashbuild is more exposed to. So there is still a lot of pressure in that sector. I do like both these companies. I think their share prices are quite cheap because they've been hammered on the back of weaker results for a few periods now. But at some point, things are going to turn, whether it's because of the two-pot system withdrawals or just because we have generally higher wage growth and higher employment in the country. That'll be very beneficial for the likes of Cashbuild and Italtal. Italtal must just sort out the issue we have regarding gas and the supply of gas that's coming to an end in the next 2 years, because they use a lot of gas in their kilns to make the tiles. But except for that one issue that you need to keep your eye on, I like Italtal and Cashbuild shares at the current prices.
Yeah. It's quite interesting because a lot of people do like these stocks, even though the economic situation is just not very supportive of it. Even today, I mean, we did get high unemployment figures. We did get unemployment ticking up. Yeah, Roy, I mean, looking at these stocks, do you need to kind of, in terms of your investment outlook, kind of divorce them from the current economic situation?
The thing is, for most people, your house is the biggest investment you'll make in your lifetime. And when you get into that mortgage, it's 20 years. Styles change. You have an upgrade cycle that comes every so often, whether it's interest rate sensitive or anything. So it tells you that in a country like South Africa, where home ownership is a big thing, this is a crucial part of people's life and their livelihood and their wealth building. So yes, for sure, when people have a bit of a chance to upgrade and spruce, remember during COVID, you saw a big boom of people fixing up their houses, stuff they didn't notice when they were going to work and stuff. So yes, it's tightly entwined with people's perception of their own self-worth and of their long-term legacy and their wealth. So I think well worth looking at. I mean, for instance, Italtal caters to everyone. It's got from the high end with Italtal to the middle and the lower end with Top Tile, the import, they've got good variety. Yeah, it's just difficult times for them. Maybe competition is there on the manufacturing side, but these are well-run businesses that in a growth environment would do a lot better than they're doing right now.
All right. Well, let's get to some of the questions that have come through. MAAF, yeah, quite a lot of questions on MAAF today. Firstly, why is the share price of MAAF still undervalued even though the dividend yield is more than 20% and consistently having reasonable good results? Is it worth reinvesting the dividend yield in the same share, JP?
I think the issue is the word consistently that you used. If you look over the long term, the ferrochrome market that they're exposed to does not show consistent profitability. It's quite cyclical. Ferrochrome still mainly goes into the steel making sector to make steel extra hard. And because of what's happening in the Chinese construction sector and property sector, it's mostly down, but then because it's quite concentrated, the ferrochrome supply from South Africa, it means that has supported ferrochrome. And you get interesting dynamics in the ferrochrome market regarding prices that can move sharply up and down. And therefore, the profitability of MAAF at times have moved sharply higher, or they've been in a loss-making position for quite a while. So at the moment, then that purple patch, making a lot of money. Some of the kilns are still closed down. So there's even the possibility of opening those up, starting those up again. Yes, the dividend yield is about 20%. Yes, you can buy more MAAF, but you don't need to. You can buy other shares as well. And I think if you already have exposure to MAAF, which is quite cyclical, it might look cheap based on the dividend yield, but I would rather take that cash and maybe invest in a different share to diversify my portfolio.
Yeah. Well, I mean, we have seen an uptick in the share, and of course, they did release results yesterday. And the other question is, what's causing the MAAF Resources price hike? And is there still upside in the short term and long term? Roy, is this one that you look at?
So when you look at something that's got 40% of its market cap in cash, 28% dividend yield, I mean, you'll see it's attractive, but you have to delve into the fundamentals. And I think JP talked about it quite concisely. The thing to remember is that these guys have been negatively impacted by rising electricity prices. That has made them struggle in terms of production, and they're effectively ex-growth as it stands right now. So yes, there's cash. Yes, the balance sheet is cash rich, and yes, you get your 28% div yield. But like JP, I would say if you get that cash in your hands, go look for something that's growing. Go look for something that's less cyclical. Go look for something that's a lot less niche, that's not exposed to high electricity prices or the commodity cycle. That I think would help you as an investor because you'll be looking for things that are not closely correlated.
I mean, yeah, based off of what you guys have said, I don't think you'd be going into ArcelorMittal. There's a question here. They're saying that they're looking at a funding solution to address balance sheet. Do you think they are talking about a possible rights issue, JP?
Yes, it's one of the options because unfortunately they are loss-making, and we know that the Fundable Park operations, they even considered closing some of those significant lines of business. And then finally they decided, okay, they'll keep it open for a little while longer. Hopefully we'll have this economic growth and support from government so they can keep that open.
Yeah.
Or one needs to make the strategic decision and say, do we need local steel manufacturing in this country? I read in an international newspaper this week that Chile's only a steel manufacturer closed down in the past week.
Wow.
A lot of companies just decide, well, if we can't compete with the Chinese, we close our own steel manufacturing and we import everything, which is fine. But what happens if the steel prices spike higher or there's a problem with your supply from China? So I understand that it's one of those sectors which might have strategic value and therefore might necessitate some government support. But yes, there'll need to be some shareholder support as well, including possibly a rights issue, because ArcelorMittal is loss-making. I looked at the share 18 months ago and it looked very cheap on a PE basis and a price to book, tangible book basis. But lo and behold, when you have a few periods of losses, all of a sudden your tangible book is lower, your PE has gone negative, and it doesn't look so cheap anymore. So they need to sort out the balance sheet, and a rights issue might be one of the tools that they need to look at, yes.
All right. I just want to go into property, and quite an interesting question that's come through. What's the panel's opinion on global property equity funds on the JSE, such as One Invest, Signia, MNG, Retway, etc.? And what is your opinion on these funds as a diversifier within one's portfolio when compared to traditional REITs with both SA and global exposure? Roy?
That's an interesting question, and I think the answer begins with that term you used, diversifiers. So the thing about them is, and my assumption here is that these are basically ETFs. So they have a broad spectrum of investment vehicles within them, and they give you exposure to a large number of markets. Your local ETFs would be focused here with maybe an asset in Spain or Eastern Europe or something like that. So it's more concentrated. So you have more specific company risks. Those vehicles give you diversified exposure to different markets at very low cost. So that's where the consideration would be. At this point in the cycle, when interest rates look to be coming down globally, companies, REITs and all of these collective investment vehicles should actually start looking attractive to investors, nice diversifiers from equities, and maybe a geared return from interest rates coming down. So yeah, definitely well worth looking at.
And JP, would it be one or the other, or do you think that there could be space for all of them?
Well, it's sort of like... you know, you get that sweets called all sorts, licorice all sorts, but they're all still licorice. So for me, it's similar, where whether it's an ETF, exchange-traded fund, or an ETN, exchange-traded note, or an AMC, actively managed certificate, or an active ETF, or a passive ETF, or a unit trust, they are all basically just a wrapper, just a different way to hold a property portfolio. You need to look at the differences of the actual property portfolio, not necessarily at the wrapper, at the vehicle. So look at the licorice, not the all sorts type of what the licorice might look at. And on that basis, you can look at the portfolio of properties being held, and that should be your determinant. And then it really doesn't matter whether you buy into a unit trust, an ETF, an ETN, or an AMC.
I mean, would it be wise to be stock picking within the traditional SA REITs at this point, Roy? You're talking about obviously the expectation that interest rates are going to come down. Do you think that maybe this would be the time to actually be looking for opportunity?
So exactly like JP says, it's the same thing. It's basically an asset that is income earning, and the way they've wrapped it around, there's a certain level of yield that it's offering you. These ones, they do well when long bond rates come down, and the long bond rate has come down quite a bit. So you've seen their prices go up. Maybe it goes down a little bit more. Who knows? But that's the decision the investor needs to make. The thing about most of them is they're up to 50, 60% locally invested. What the question you're asking yourself is, does the management team have the expertise and the ability to look into all of these other countries as well as they have here? Again, do your own research. You have to look at that detail. At the end of the day, what you're investing in is a bond proxy. Effectively, what you're looking for is lower interest rates and diversified in terms of the type of property, the region, the mix of industry and that sort of thing. So yes, when you talk about domestic ones, definitely look at them. Remember here as well, you've got the distinction between the very liquid ones and the less liquid ones. So no, there's a whole world of choice there. Like JP says, there's everything. Whichever wrapper you want, it's there.
All right, well, let's look at the tourism wrapper. Sun International. What are the prospects for Sun International in the next 12 months? JP?
So whether it's Sun International or Southern Sun or Togo Gaming, I like all of these, call it leisure stocks. I'll throw in City Lodge as well. It does seem like international travel to South Africa, tourism is picking up. Some regions more than others. So Southern Sun, with their exposure more to Cape Town, might do better, for instance, than Sun International, which is more exposed to resorts, and specifically resorts that are closely or in proximity to casinos. So there's a lot of exposure in Sun International. People would know Sun City, perhaps, up here in the northwest of the country, but there are a few other casinos as well that Sun City owns, so that Sun International owns. So you need to think about hotel occupancies, and you need to think about propensity for gambling. And if you put all of that together, I would say the next 12 months looks quite decent. Remember, they also recently bought the holding company of Emperor's Palace next to the OR Tambo Airport. And that could give them a real boost. It did increase their debt, and they need to pay that down. But that could be quite significant for them if both occupancies and gambling propensity is strong over the coming 12 months.
Yeah, you talk about propensity to gambling. Is there maybe still this kind of like tug of war between your counters that are exposed to your brick and mortar gambling facilities versus the online gaming, Roy?
Oh, without a doubt, yes. But punters are punters, right? The thing about it has been that the online has come on quite strongly, but I think the tradition has always been around the entertainment and the bricks and mortar, which allows these people to travel. When you have strong consumer confidence, high wage growth, strong economies, then you see the volumes go up, because the guys who come to the floor, the guys who want to take a flutter, as they do the restaurants and all of that, all those numbers grow. During these difficult times, I think the numbers get quite stratified, and you get people who are, would I call it, independent of the economic difficulties, are the ones who continue. But yes, it's all about consumer confidence. It's all about being happy that the economy is growing.
All right. Well, shifting from consumer confidence to investor confidence, let's talk about Coronation. Does the panel have an opinion on the short-term performance of Coronation? Yeah, let's actually start off with that one. JP, Coronation?
So now that they've won the tax issue, at least we know that tail risk has been mitigated. Now we can get back to the fact that if you want to have an opinion about how well Coronation shares will do, you need to look at how well the funds are doing, the funds under their management, and the flows. Are more people investing into their funds, or are people redeeming out of their funds? And the last few years, the tendency has been for people to withdraw funds, not just retail investors, but also institutions, which is basically pension funds to a large extent, as we've had a dampener also on people entering the workforce in South Africa. And the performance has been okay, but also not as good as what it was, call it, a decade ago for the Coronation funds and how they outperformed the benchmarks. So if they can get back to the good old days of the previous decade, then Coronation shares look quite cheap on a very high dividend yield because it's all cash earnings. While if the performance of the funds start to struggle, that will lead to more outflows, and that's sort of become a self-fulfilling prophecy. You can have quite a lot of momentum build up when it comes to bad performance, precipitating outflows, precipitating even worse performance.
Yeah.
So the asset management industry is an interesting one. When things go well, they go really well. But when things go bad, they can also go really bad, unfortunately.
Yeah, well, actually, the second part of the question is basically just your perspective on the industry itself, on the investment houses. Roy, how would you be grouping the industry in itself at this point?
So the industry has transformed quite a bit. Like JP was saying, 10, 15, 20 years ago, these standalone asset managers with star fund managers and everything were all the rage. But what's happened is it's moved from standalone equity managers with equity mandates to platforms where you have multiple products being offered with underlying fund management. So fund management itself is not the issue, it's the products that are wrapped around it. That's where companies like Quilter, even 91, St. James Place in the UK, that's where the industry is going, because people want holistic management. Nobody specifically wants an equity mandate that invests only in SA. That's stuff people like JP and I talk about. But for when you're out there, when you're Zenati with your wealth and everything, what you want to know is, what do I need to do to retire well? What is my legacy? How do I handle my savings? That's how the industry has developed. And I think that's why they've seen all of these outflows. People don't want specialist managers. They want platforms. They want to be able to think about broader things than just equities or just fixed income. So it's transformed. It's changed. But if I look at Coronation, remember, one thing they have going for them is they've got a strong owner-managed culture. They pay out most of the earnings as dividends. If you trust the management team, their fortunes are tied in with yours. They'll pay out the solid dividend. They'll do everything they can to handle the industry and the industry transformation as it's going. And you could be a winner with them as well. So when it's owners managing, you know that your interests and theirs are in the same pot. So that's just one slight consideration. But I agree totally with what JP was saying.
All right. Well, gents, let us get to your stock picks for today. JP, what are you picking?
I'm picking an offshore share again, one that's listed in the US, but it's a Cayman Islands company with significant operations in China, PDD Holdings.
Okay.
They've got a big platform in China where it's group buying of agricultural products that really has grown from nowhere to becoming a very big buying platform in China. And then South Africans might know the platform they then launched internationally called Temu. So if you buy anything off Temu, you are effectively a customer of PDD Holdings and their app, which connects the producer or manufacturer of whatever products you are buying in China directly to the purchaser in all kinds of different countries around the world. Now, what a lot of countries have done is they've closed the loophole where for very small imports, there was no import duties, no tax in South Africa and in other countries. And because the local retailers in all these countries have not liked the challenge that Temu has offered in terms of being cheaper than bricks and mortar retail, all the governments around the world are starting to close this loophole. And if you buy something off Temu, you will now pay import duties as well. Notwithstanding that, I do believe that the platform is so well protected in terms of its position against competitors that even if you have to pay import duties, it will still be a very attractive way to bypass all the middlemen and buy directly from a manufacturer, mostly in China. So because of that, the share price hasn't quite done as well in the last few months as it has before that, because people were concerned about the import duties. I think they'll power through this and still grow their profits very strongly.
All right. Well, what are you feeling strongly about today, Roy?
Today I'm going to stick local, and I recently saw the results from Nedbank, and this is a business that it started to impress me. I know the share price has moved quite a bit, but historically they seem to have a problem around their property portfolio, and they didn't have such well-developed retail and investment banking, but that's changing. They've got a new CEO. They seem to be well geared to any improvement you have in SA. They don't have the hedging issues that other banks have. And remember, they also don't have the Africa exposure. So if you're a little bit nervous about African exposure and you're looking for very focused SA exposure from a banking perspective, especially if you expect GDP growth to recover over the medium term, I think Nedbank should be something that you seriously consider.
All right. Well, thank you so much for your time and for your analysis today, gents. Much appreciated. That is all for tonight's Stock Watch. Thanks to our guest, Pierre Verster from Protea Capital Management and Roy Mutooni from Sanlam Investments. Up next, the close. Stay tuned.